right now. Anyway, Volatility Skew and your guide to understanding volatility. To kind of kick this off, we've done a number of coaching sessions on volatility. We've talked about volatility over here, but first, some of it is always going to be review. We got to get everybody on the same page when it comes down to volatility. So the first thing we're going to have a discussion on here is what's volatility. By the way, we're going to make this an interactive session. So jump in here anytime over there, fire questions. I'm reading the chat room. Again, if you guys are brand new here to TheoTrade, the way this works is right here. You're actually watching the presentation. When you're watching the presentation, right over here in the lower right-hand side of the screen, okay, you want to switch this to HD, which is 720. Okay, so you're actually going to make sure that you're viewing in crystal clear clarity, and you can also maximize the screen. Additionally, if you're chatting in down below, okay, if you chat in down below over there, well, you can even break the chat box off. When I say break it off, you can actually take it, detach the chat box, and have a ball. But I do read the chat, so I'm more than capable of talking and reading over there. Anyway. We're gonna get rolling over here. So the first thing we start with, again, what is volatility? When you guys start thinking about volatility, you're like, what is volatility? And a lot of the times when I describe markets, I'll use the same slide like again and again, like this is volatility. No, this is the way that I kind of describe markets. All right, we're not going to use like a full slide deck tonight. I just like to start. Sometimes a couple of blank slides over here, but I like to start with a few slides just so that we are all kind of on the same page. And, when you kind of think about volatility, what is it? I mean, that's the first thing you got to start with. All right. So with volatility, when you're thinking of volatility, the first thing that kind of comes to people's mind is, here's like $100 stock, and it's a stock that's, oscillating all over the place. Yes, it's an infinity sign, right? So the stock that, it can move a lot. And that's one of the first things that comes to mind when people are talking about volatility. Now, I'm going to kind of call this tonight, and we're going to keep this to about an hour tonight, and I'm going to kind of, your guide to understanding volatility. So, number one, let's not just understand what volatility is, like, what can you do with it? What can you actually do with volatility? Okay. After that, how can you use it, of course, in your trading over here? Yeah, we're going to get to that. We're also going to discuss, all right, a couple of other aspects of volatility that you may or may not be familiar with. And some of them, it's going to be a surprise. But the first thing, when we talk about volatility, I'm going to clear the board over here. Most people think of volatility, and again, this is a $100 stock, as, what? Movement. Okay? So, movement. Movement is what they're thinking of, like oscillation, how fast the stock can move up or down. But that is a definition for volatility. Okay? But that actually references what they call historical volatility. So one of the first things we kind of kick off tonight's session with is when we're talking about volatility, let's clarify what we're talking about. So there is, historic volatility, and there's what we call implied volatility. All right, so historic volatility, implied volatility, imp volatility. Implied vol, is the one that really comes from options, and that's a lot of what we're going to focus on. So what's historic vol? Historical volatility, specifically historical volatility, found in almost any charting package out there. Okay, and if you want a definition for it, here it is. It's the annualized standard deviation of past stock price movement. Now, I know that really excited a lot of people. Like, oh, I like it. Historical volatility. If you're an engineer, that did it for you, right? The annualized standard deviation of past stock price movement. You're like, what does that even mean? Okay. Again, only an engineer could possibly understand that wording. By the way, yes, here at TheoTrade, we pick on engineers, because I think I was supposed to be an engineer. I might have missed my calling. And apparently we do pick a little bit on Canadians. So if you're a Canadian engineer, you're screwed, right? I like it. So it's a good starting place over here. By the way, why Canadians? there was a question that came up, why Canadians? Why do I pick on Canadians over here? All right. So I worked at Thinkorswim for quite a number of years. Thinkorswim, 2009, was purchased by TD Ameritrade. TD Ameritrade, 45% of the company is actually owned by Toronto Dominion. So I was, pretty up the food chain there. I had to go to a lot of meetings. Many of those meetings were in Toronto. Okay, Toronto Dominion Bank. So I spent a lot of time in Canada. Those were the single most painful meetings of my entire existence on this planet. And now every Canadian shall pay. Anyway, that's the long story long version of it. They were brutal meetings. 6 hours. Okay, and I don't wear a tie for nobody. I don't wear no tie. But up there, you had to wear like a suit and stuff. It was 6 hours to talk about absolutely nothing. What was accomplished at the meeting? Nothing. So we have historical volatility, the annualized standard deviation of past stock price movement. And when you talk about historic volatility, what you're really talking about, it's like, hey, it's stock movement. If the stock's oscillating a lot, people say, oh, it's volatile. Okay, but that's really not the kind of volatility that helps us. Why? Okay, because everything that happens on a chart happens where? In the past. See, in that definition, historical volatility, the annualized standard deviation of past stock price movement. Yeah, I'm not really worried about the past. I want to know what the future holds. What does the future hold? Implied volatility holds the future. Why? Because options, all right? And I'm going to make an argument always. Even if you never had an intention of trading options, there's just a vast number of people, okay, in the trading world that are just opposed to options. There's people that get on TV all the time and they're like, yeah, don't trade me none of them there options, okay, which is shocking to me because they'll be talking about like earnings for Apple and they don't look at the options that, for instance, okay, are 9 days out, or they don't look at the options that are 16 days out. Why? Why don't they look at those options? Because they don't even know what they are. If you did know what they are, the 9-day out options, okay, its implied vol is actually estimating expected move in the stock. And don't you think it's important to look at the options on something like Apple? Okay, so now we're going to deviate. We're going to go over to a trading application. And we're going to look at something like Apple, just to make a quick point. Then we're going to talk a little bit more detailed about implied volatility. But the argument that I'll make is, here's a 9-day option. Why did I pick the 9-day option? I don't know. Just seemed like a good thing to do, right? There's a couple of thousand contracts open over here. And I close up the 9-day option. And I open up something like option statistics. Okay, so time out for just a second. And if you don't even know what option statistics are, that's fine. Doesn't matter. There's 372,000 options that have traded inside of Apple today. Want to know something right off the bat? That ain't even half of the normal. Only 47% of the norm traded. And 26 million shares of stock traded hands today. Contracts. Contracts? It's equivalent of what? 100 shares of stock. So the way to look at this is, the equivalency. You put a couple of zeros after this thing. And seriously, put a couple zeros after this, and what do you got? You got a ton, okay, just a ton of trading activity that's going around options. And I just can't stress this enough. Options today, in many cases, move the stock. Options today, in many cases, move the stock. And the argument, okay, that I'll always make is if you can't look at option pricing, you're blind to see what risk lies ahead. All right, so 9 days out, what are options doing? Well, they're putting a price tag on risk 9 days out, which brings me to the next point. What options really do, okay, is they put a price tag on risk. So options put a price tag on risk. So the next time somebody says vol, they really mean risk. Volatility is a nice, comfortable word in Wall Street, for risk. They're like, there's a little patch of volatility over here. Why don't they just start screaming on TV? There's just a big patch of risk, all right? And you're about to fall into it. So vol and risk, they're synonymous with one another. One last explanation on this front, okay? So many people are familiar, all right, with the VIX. The VIX is probably one of the most, quoted numbers on the street, almost as much as the S&Ps and the Dow. So if you look at the VIX, and the VIX, for example, is somewhere near 15. A lot of people misquote how the VIX is even, they say, they're like, oh yeah, the VIX is at 15. No, the VIX is at 15%. Volatility is always quoted in percentage terms. So if you're saying the VIX is at 15, you're saying it's at 15%. Now, what does that actually correlate to? We're going to get to in a moment. But one of the relationships that I want to be clear before we even really explain volatility, and if you're kind of new to the market, here is the S&P 500. Where did the S&P 500 go today? All right? So here's the S&P 500. Where did it go today? It went where? Up. Okay, how much did it go up? About 20 points. Oh, I can't write. About 20 points up on the S&P. Where did the volatility go? Down. So, down equals the risk. Not vol, let's call it risk. So you're seeing a 20-point up move. Risk is actually falling down. The reason I'm adamant about this particular example before really ever explaining volatility is to know, okay, that volatility clearly wouldn't be movement, because on a day, okay, where the S&P moves up and up fairly dramatically, okay, you're getting volatility falling down. So here's the VIX, it's down about 14% today. Here's the S&P up 21 points. The Dow could be up 300 points in a day, but the VIX is going to fall. So you can't really tell me that volatility is movement. Okay? Again, remember that volatility is synonymous with risk. Now, here's the point that I really want to get to. When people say, hey, give it to me in brass tacks, what is vol? So remember a moment ago, we were talking about the VIX. And the VIX, we'll call it at 15%. What that really correlates to is, let's say the VIX, all right, was this $100 product. And that $100 product, whatever it is, had a 15% equaled its volatility. Now that volatility that we're talking about, once again, is the implied volatility. That means that stock is capable of going, okay, approximately up 15%. And the reason I use a $100 stock is it makes the math really easy, right? It's capable of going up to 15%. We're down about 15%, which takes us to what? Okay, about 85. What this number, okay, happens to be, the 15%, that is one standard deviation. So when you look at volatility, right, realize what volatility is quoting is this. It's a 1, okay, standard deviation move, okay, within, I cannot write with this thing, within 1 year. So it's one standard deviation move within 1 year. So when it says 15%, that's actually standardized for a year. So it says this stock, whatever stock this is, okay, can move up about $15 or down about $15. So it's got this, what? It's basically saying plus or minus 15%. That's what this really means. That's what volatility, okay, equates to. And it'll stay in this range, not all the time. It stays in this range, one standard deviation. One standard deviation happens to correlate to 68% of the time. All right, time out. Everybody okay so far? Are we feeling it? Okay, because this, there's a lot of numbers that I'm throwing at you over here. All you got to know at this point, okay, volatility is risk. That's number one. Number two, volatility means standard deviation. Standard deviation You're like, what? If you don't remember standard deviation, 68% of the time, remember, in this curve, everything, I always say this, like everything I think you could do in your life can be fit in a distribution curve, okay? Some of you guys are like, yeah, that's how I got through college, or that's how I even got through high school, because there was what? They skewed the curve to fit you over there. So area under the curve. So anyway, what you basically get is, whatever you do, I always say there's good drivers up here and there's really, really bad drivers. Wait. And there's Canadians, right? Down here. Oh, come on, that was a cheap shot. But if everybody's a bad driver, then the curve moves, and 68% of us, we might be crappy drivers, but you're still in the meat of the curve. That's kind of how it happens. So 68% of occurrences, okay, of whatever the stock happens to be, is going to fall between 85 and 115. Now, how can that data help us? It can help us a lot. But there's a problem with this. What's the problem? Okay. Boy, you guys are not very interactive tonight. It's a pretty quiet group over here. So I haven't stirred up anybody. Even Brian up in Canada. He's just like, I'm gonna sit here and again, happy hour with the options. But what's wrong with this picture? To me, I'll tell you exactly what's wrong with this picture. All right? 1 year of time is what's wrong. Who cares what it does in a year? Like, oh, come on, man. I'm placing a trade for this month, for the next 9 days, for the next few days. Okay? So what we need to do is we need to extrapolate. Okay? We need to extrapolate out. It's great that, for instance, you may have a stock, and that stock, it could have like a 40% volatility. And a 40% volatility, again, on a $100 stock, you're like, that's huge, man. That means that thing can go up to like what? Out there to like 140 or all the way down here to like 60. But that's within what? 1 year. And again, that's one standard deviation, which equates to 68% of all occurrences. But what good does it do when I'm plus or minus $40 in 1 year? What we need to actually do is we need to take this 1 year, okay? And I give you the most simple terms. If it can move $40 in a year, couldn't you, all right, ultimately divide that out by 12? And 12 being what? 12 equals months. And that way we can figure out, well, how far can this stock move, not in a year? We can actually figure out how far the stock can move within a month, okay? Well, there's actually a formula for that. And that formula is actually what they call expected move. So this is a formula that isn't necessarily on a lot of trading applications, but I can show you the quick and dirty methodology of it, okay? Expected move. So we're going to call it an EM, expected move. What expected move means is you have this $100 stock, okay? The question is, how far can this $100 stock move within, for instance, 9 days? And all you have to actually do to figure this out is you have to have one input, okay? The real input that makes all the difference, okay, is implied vol. You already know the time frame. You already know the stock price. All you need is the implied volatility, and you can calculate how far the stock can move within 9 days. Let's apply implied volatility. Let's say the implied volatility is 20%. Okay, multiply that by what? The stock price. Okay, then take that. You're going to love this, right? For those of you that are engineers, take that. Take what? 9 days. Okay, and ultimately, what are you going to do with the 9 days divided by 365 days? Okay, so it's the square root of that. Ultimately equals expected move. That's the equation for it. The implied volatility, though, get it wrong, the whole thing is messed up. You never have to calculate this. Never. You never have to calculate this. Why? Because the market is way too smart. The market is like much smarter than people really give it credit for. And when I say the market's like really smart, okay, first of all, again, you don't have to be like on Thinkorswim because somebody's, tuning in right now from like Australia. Anybody here tuning in from Australia right now? What is it? It's like 10 o'clock in the morning there. So depending upon where you are. So one of my best friends growing up and through college, I went to school in Australia for about a year and a half. I lived in a little town called Townsville, way up in North Queensland. By the way, this time of the year, it's finally starting to get cool. But, it's like 95 degrees every day, rains. You're basically living in like the middle of a rainforest out there. It's good stuff. But if you're, just Florida. Okay, close enough. Anyway, no Aussies tonight. No Kiwis. We usually get during the trading day, we get some Kiwis and some Aussies. So some of them, work during the day. All right. Anyway, the point that I'm trying to make, markets are incredibly sharp. And here, and by the way, I was mentioning Aussies because you can't have a TD Ameritrade account down there. So that's, I'm sorry. Apparently they, distinctly don't want the Aussies. We do. We'll take you. Okay. On Thinkorswim though, they factor in expected move. Okay. Anyway, almost married an Aussie. All right. I think actually you ducked out at the right time. I'm gonna have to give you that one. So sorry, I gotta stop reading the chat room over here. Almost married an Aussie until you realize, all right. Anyway, so they calculate expected move on Thinkorswim, which can help you substantially. It's plus or minus $3, but you never have to calculate it. Just look where the stock price is and look at the at-the-money straddle. The at-the-money straddle is the at-the-money puts plus the at-the-money calls. Okay, so if you add it up, it's like $1.40, $1.44. What does this come out to? I mean, just roughly, just make it rough and dirty. It comes out to about $3, which is really freaking close to the expected move over there. So there's just no reason to that calculation. Why do I show you the calculation? Engineers, I blame you. I do. All right. What the market is saying right now is there's like a $3 expected move. Again, the market's smart. It's saying $3. What's expected to happen? Well, it stays in that range 68% of the time. And to show you how smart the market is, people think that crazy stuff happens around earnings. Yeah, earnings are already priced in. They're totally priced in. Look, the volatility here is already sitting at 32%. All right? $7 expected move. Let's go over to something like Netflix. Markets are way smarter than people give them credit for. So Netflix, the earnings are coming up in the 16-day window. So let's display it a little bit here. Let's talk about it because Netflix is displaying almost an 80 vol. Now, people really believe that volatility goes up before earnings. It's actually a huge misnomer. And the volatility might go up, and it does go up, but it's to keep the expected move in and around $13 or $14. This expected move is the most important thing coming into the earnings announcement. It's actually where we're headed here momentarily. So, time out for a second. What have you learned so far about volatility? Volatility is helping you determine expected move. But you don't even have to know the percentage. You just have to know plus or minus $5. Well, there is a difference. I'm going to tell you why. Why is it so important to understand? Just understand what I taught you about implied volatility thus far this evening, and you're way ahead of the game. And this is the reason why. Forget for a second about stock price movement. Okay? The most, I believe, beneficial area of implied volatility is that all implied volatilities are standardized. What? The heck does that mean? This is what it means. Netflix is a $104 stock. Is there any other $104 stock you guys can think of? Just look at Apple, because it's close to $104. How do you compare Apple to Netflix? I know that one's wide open for interpretation. I don't know what you're talking about, man. Okay? This is what I'm talking about. One of the most beneficial areas, okay, where I always tear people apart that refuse to look at options, and this is why I tear them apart. So, and this actually comes from, while working inside of TD Ameritrade for 18 months, I left the retail trading world, completely left the retail trading world of Thinkorswim and TD Ameritrade. And for 18 months, I actually built the institutional education division of TD Ameritrade. Okay, which is, by the way, it's one of the fastest growing divisions inside of TD Ameritrade. But the institutional education, what they did in that group, what I ultimately built in the group, was we went out and we taught registered investment advisors, okay, about options. Because obviously, self-serving, right? If a registered investment advisor that manages other people's money trade options, people are going to trade a crap load of options. The RIAs are going to trade the options. Anyway, the registered investment advisors, okay, most of them have 70, 100, $300 million under management. So we went out and we started talking to them about options. And they go, yeah, whatever, man. A lot of them were just like, listen, I go out there and I buy mutual funds. I go, okay, this is the number one area that we used to teach them is right here. I go, what's the number one holding you'd have? And they go, something like Apple. How many shares of Apple do you trade? And they go, for an allocation, we would go out and we would trade X number of shares of Apple. And then I go, all right, so you trade X number of shares of Apple. Okay. Then I'd bring up a similar price stock like Netflix. And I'd say, listen, Apple is $110 stock. Netflix is $105 stock. How many shares of Netflix do you trade? And they usually tell me the exact same number. And I'm like, what? Are you out of your mind? Okay, so what they were doing is they would allocate based in dollar terms. They would say, if we're going to do a $100,000 allocation to Apple, they're going to do a $100,000 allocation to Netflix. Do you see an issue with that? Because I do. Implied volatility is standardized. And what that means, it's in percentage terms. So percentage terms allows you to look from one product. Okay, let's forget that earnings even exist. All right? We'll forget that, come on, get off there. We'll forget that earnings even exist. And you look at Netflix, just here. It's trading right in and around, let's see if we all agree over here, it's traded right in and around, let's call it a 40% vol before the earnings, right? That's the 9-day. But that's like more of a norm, right? It trades around a 40% vol. And it's a $100 product. Versus Apple. Apple, okay, in the 9 days, it's trading around a 20 vol. For allocation purposes, how do you allocate differently from Netflix to Apple? Because if you're going to trade, whether it's stocks, whether it's options, even futures contracts, every product that you trade, you have to allocate different amounts depending upon what? What is another word for volatility? It's risk! Netflix is pricing double the risk of Apple. If you trade shares of it, you should probably be trading half the shares in Netflix that you would in something like Apple. Apple's slow, methodical beast that can't move. Netflix is a wild animal. That's it. That's what you're dealing with. And let's go over to none other than Tesla, because Tesla, people think, it's a wild beast. Tesla, it's getting up there. It's almost a 50% implied volatility, and its earnings are all the way the heck out here. So what has even more volatility? Tesla. You want even more volatility than that. And again, you have to start thinking in these terms, because Netflix, what it's saying, it's giving you twice the risk, twice the price action. So we're actually using options, okay, to not determine anything about trading the options. We're using the options to determine how deep I'm about to get in, right? And if you're ever going to allocate capital, even contract size, right, Netflix is going to break you in half, okay, twice as fast as Apple. And if there is one thing, okay, that experience tells me, people lose twice as much money in Netflix and Tesla as they do in Apple. Why? Because it's twice as volatile. It's literally that easy to figure out, okay? So the next time that you look at a product, the first thing that I do when I look at a screen, and I've had years of training to do this, but I don't even look at the price, okay? Because if I'm curious about Tesla's price, I see it on my left-hand side bar here on Thinkorswim. I see it on a quote list. Like I kind of cruise from charts. Yeah, I look at a chart. Oh, it's very exciting. So I'll look at a chart once in a while. Okay, but where I spend a lot of time really looking, I actually look at this left side bar. I just look at my quotes. If I ever go to the trade tab, first thing I look at is the right-hand side of the screen, because especially on stocks that I don't know, I don't even look at the price. And just deadly serious about that. I look at the right-hand side of the screen because I want to know, okay, what I'm dealing with. So, you walk down some dark alley in a really bad neighborhood and somebody pops out, the first thing you're thinking, oh crap, what am I dealing with here? Okay? Then you realize, you're in Canada and you're probably going to be fine. Anyway, the first thing you got to know is what you're dealing with. And in Tesla, you're dealing with some pretty serious crap. It's got almost a 50% volatility. That should trigger something in your head immediately that says, I'm going to trade infinitely small size. Then you look it over something like Google. Now, people expect Google, oh man, that's a volatile animal. No, it's not. Compared to Apple, it's even lower volatility than Apple. Google is a nap. It's taken a nap. Okay, but you moved $10. Yeah, it's a $760 product. It's sad when I have to bring up Walmart. Don't make me have to bring up Walmart. Walmart and Google can be compared to one another now because they're only 2 percentage points away in volatility. All right? It's pretty sad when you got to compare Walmart to Google. Okay? In fact, I bring up Target because Target, I know I have positions in here as same volatility, okay, as Google. And you never thought of the tech behemoth like that as having rather low volatility. But you really want to know what Google is? Okay, and some people have heard me say this. Google, it's GE. It's our generation's, my generation's GE. If you grew up in the 70s and the 80s, GE is one of the big blue chips over there. IBM is a big, big blue. Today, big blue is Google. Okay, and that's why its implied volatility is inherently now low. Ultimately because, it's become a behemoth, huge market cap out there. It's a good place to start. All right, so Apple versus Netflix. Again, you have to think about trading half the contract size, especially when you start to look at earnings announcements. Do you realize when the earnings announcement comes inside of Apple, it's only dictating about a 32% implied vol. It's a $7 expected move. And I said Netflix was about double the risk. Netflix, okay, in the 16-day period is looking at a $14 move. It's almost precisely double the implied risk out there. That, to me, if you just stopped right there and never looked at anything in volatility, you're going to be much better off for it. Okay, and it's just something I always want to hammer home and reiterate. And so you guys know, I would go out and I'd do presentations in front of these registered investment advisors. And this is a bunch of people that you can't tell anything to because they already have $100 million plus under management. Okay, so the first thing we would start them with is implied volatility and comparing one underlying to another. Okay, and usually in the first 10 minutes of this conversation, you're like, that's ridiculously cool. Never thought to look at options, okay? Because the options, it's not just predicting stock price movement. The options are dictating stock price movement. There is so much skin in the game. Look at this, 5,000 contracts over here, a couple thousand contracts out here. A lot of skin in the game. Billions of dollars are being traded in options, controlling and moving the stock. If you look at option statistics in here, 80,000 contracts. And here's another interesting day. Netflix today closes down. It only traded 47%. You don't think that's statistically significant that all of a sudden Apple, Netflix trade and they barely trade any options today? Okay? It's unusual, isn't it? And I was looking at this earlier today. A lot of these giants, Google, same exact number, 47, 48% of the norm traded in there, okay? Which basically means, yes, the market moved up today, but nobody did anything. Now, Amazon had a breakout day. I would expect Amazon to be a little bit higher over here, but there's so many interesting stats that you can find out there. It only traded 70% of norm on a big breakout day. What does it mean? Okay, it means the move means absolutely nothing, no conviction behind it. I like it. Okay, so now we're going to continue onward and upward. Here's a question that came in and said, what do you consider to be the dividing line between low vol and high vol? It's, man, I got to tell you that it depends on the overall climate of the market. Okay, so I remember back in 2004, 2005, 2006, 2007. Okay, there's only one way to say what volatility was back there.